Welcome to Financial Management Accounting. So we're going to look at the theoretical part of the paper. Then we go to the calculations. So the conceptual framework and the qualitative characteristics. So describe the qualitative characteristics of accounting information prescribed in the conceptual framework and discuss the constraints of the conceptual framework. So when you're dealing with the conceptual framework, these ones don't miss. Okay. So conceptual framework is basically we're looking at the framework for accounting reporting, and it's issued by AIAS, the International Accounting Standard Board. So it outlines the qualitative characteristics that make financial information useful to users like investors, like the lenders, regulators, and other stakeholders. So these characteristics are categorized into two. We have the fundamental characteristics, okay, and the um, enhancing characteristics. So who remembers which ones are the fundamental characteristics? We came up with our own formula. Fundamental characteristics are which ones?
It must be relevant,
Okay, must be relevant, yes.
faithful representation as well.
Yes, and faithful representation. So we use the formula RF, relevance and faithful representation. So what is involved in relevance? The financial information must be relevant and that it must be capable of influencing economic decisions. So the key element you're looking at is that it must be predictive, it must be confirmatory. So reporting a pending lawsuit that could affect future cash flows will help investors assess the risk. All right. It must also have faith representation, meaning the reports must be faithfully represented to represent the underlying economic phenomenon. Like it must be complete, must be neutral, must be free from error. The elements, key elements, we're looking at it being complete. All necessary details must be there. Neutral information must be unbiased and must be free from error. So reporting inventory at actual physical costs rather than an estimated figure. So these are what we call the fundamental. Then we have the enhancing. Quickly, what are the enhancing characteristics?
It should be timeless.
Mm-hmm. Not them. Oh,
Comparable,
comparable, yes.
Verifiability,
Reliability, yes.
understandability,
Understandability, yes. Yeah, the formula CAT-V. Mm-hmm. Are you there? Can you hear me?
yes,
Yes, we can hear you.
Okay, so we've said all the characteristics, comparability, reliability, timeliness, okay? So when you're talking about each of them, you must explain them. So users must be able to compare these ones across periods and other entities. Verifiable, it must be independent of bias, okay? Independent observers like auditors can have consensus that it faithfully represents the economic phenomenon. Timeliness, it's meaning that the information must be available to the users before it loses its value, meaning ability to influencing the decisions. Understandability means that information should be clearly represented for basic users to make informed decisions from it. So that is the aspect of what? Understandability. All right, so this one you use cat V. You cannot forget that. So cat VC for variability, understandability, timeliness, variability. Okay, so discuss the constraints of conceptual framework. What are the constraints of conceptual framework? What are the two constraints of conceptual framework? This shouldn't take a lot of our time. What are the constraints? The two constraints of conceptual framework? What are the two constraints?
Cost benefit
Uh-huh.
constraint.
Uh-huh.
Um,
The cost benefit constraint. And what? Materiality constraint. So the cost constraint, the cost benefit consideration here assess that the benefit of providing financial information should not exceed the cost of obtaining it. So the people who are preparing it or the standard settlers must weigh the cost of the entity. So it may be too expensive to provide detailed segment of information for small divisions, meaning it adds little value to the users. Secondly, materiality, meaning though not formally classified as a constraint, this one acts as a filter. So only information that could influence users' decisions should be included. So material information. So travel expenses like stationery, these ones are classified as immaterial, okay, to decision making. So these are the two constraints that we can remember. Okay, so on the theoretical part also, there's element of the users of accounting. We already did that. We know the investors, lenders, management, government, and we should know what each of these ones look at. Then in terms of who are contrast a sole trader and a limited company, this should be at your fingertips. Sole trader in terms of legal status is not a separate legal entity. So the owner and the business are the same, whereas the company is a separate legal entity where the business is different from the owner. In terms of liability, the sole trader has unlimited liability, meaning the owner is personally liable for all the debts. The unlimited liability, shareholders are limited to as much as they invest. Ownership and control. The sole trader, it is owned and controlled by a single individual, where the company is owned by shareholders, controlled by a board of directors. Formation, sole trader is easy and very cheap, whereas a limited company is costly and expensive and regulated by regulators like PACRA. Access to capital is limited to owner's pocket and few friends. Company, you can access the capital market and the money market. Continuity, business dies for a sole trader upon death. For company, it's perpetual, so company continue for a foreseeable future. Taxation, the business is only taxed on the owner's personal income, whereas company tax, they are taxed corporate tax and also dividends. Double taxation is what they undergo. All right. Are we together on that? So that's a quick recap that you should know by now. So we go to um, budgetary control. So describe the responsibility of a budget committee, compare and contrast zero-based budgeting and incremental budgeting, and state the advantages and disadvantages of participatory budgeting. So what is a budget? A budget committee, to start with, is simply a committee that is responsible for coordinating and overseeing the entire budgetary process. It includes roles of the following: issuing the budget manual and timetable, coordinating preparation of the budgets from various departments, resolving disputes and consistency between departments, and reviewing and approving the final master budget before submission to the board of directors. So the committee must also monitor the actual performance against the budget. So that is the responsibility of the budget committee. So what is the difference between zero budgeting, and incremental budgeting. So budgeting always comes. So we have what we call incremental budgeting. So this one is just an add-on the previous budget. So it adjusts information with or for inflation or expected growth. So the advantages for incremental budgeting is that it's very quick and easy to make. Its advantage is that it can embrace the past inefficiencies. So if there are mistakes were there, you are going to take them through. It's not strategic. It doesn't encourage innovation. It encourages use it or lose it spending. So the incremental budgeting, most government departments, most of you use it. Those in community development, you just want to use the previous and adjust the monies that we have around here. We need to before we take them back. Even accountants themselves tell you if you don't use your monies, you assume you have no use for it. And we have zero-based budgeting. This approach is used where each budget is built on from zero. You start from scratch. You want to justify all expenses, not just the changes, but you formulate the entire budget. The advantages is that it is efficient when it comes to resource allocation, that it divides and eliminates waste. It's very strategic and cost conscious. The disadvantages is that it's time consuming and requires significant managerial skill. It can sometimes be demotivating. There's also participatory budgeting, which involves managers who are responsible for achieving the budget targets in setting those targets. So it involves managers to be a part and parcel to say, this is what we need. So participatory budget is advantageous because it motivates managers to be committed to achieving the targets they themselves set. It also gives better quality budgets because the frontline managers have more detail of knowledge than those on the panel. So it also helps the departments align goals with the overall organizational objectives. The disadvantage is that managers may intentionally set easy achievable targets and underestimate the revenue. So if you're there, you make it very easy. It's time consuming because the negotiation process could be lengthy and has potential for conflict because there may be disagreements between departments about over use of resources. How is that you're using so much and we are using so little? Is that clear and straightforward? The other theoretical question is identifying the major differences between financial management and management accounting. So the differences are number one, in terms of the primary users. For financial accounting, the external users like the lenders, investors, and government, whereas management accounting is mostly internal, managers and employees. The purpose of financial accounting is stewardship. You're using past information for reporting, whereas management accounting, you're using it for planning, control, and decision making. Management accounting has no mandate or rules that will guide it to meet those needs, whereas financial accounting has a lot of formats. We have the GAAP, we have the IFRS, the specific formats that must be followed. In terms of time horizon, financial accounting uses historical reports to present, whereas management accounting makes future-oriented budgets where you are going to forecast. The level of detail for financial accounting, these are summary reports for the entire entity, whereas management accounting is detailed, it has specific reports. In terms of reporting for financial accounting, it is periodic. It can be annual, semi-annual, whereas management accounting, it is as frequent as needed. It can be daily, weekly, as well as monthly. Are we together on that? Are we together?
Yes, we are.
All right. We go to another theoretical question. What? CVP. So describe the uses of and the limitations of CVP. Okay. So CVP stands for cost, volume, profit analysis. So it is used to calculate the break-even point, simply where our revenues are equal to the cost. So it is used to determine the margin of safety, the extent by which the sales can fall before a loss has been incurred. So CVP also helps support decisions regarding their sales volume, required to achieve a certain target profit. So if you want to target a profit of 1 million, it's able to tell you how much you must produce. It is also there to help you analyze the impact of these changes in the selling price, the variable cost, the fixed cost, and the sales volume on profitability. So what are the limitations of CVP? So number one, its assumption is that they are linear relationships, which is not often the case. So it assumes that the costs, the revenues are a straight line of functions, which is not true. It also classifies costs in two categories, which are fixed and variable. However, sometimes it's difficult to classify some costs accurately, especially the semi-variable costs that are in between. CVP is also limited in the context of their sales mix. So in a multi-product company, it assumes that the proportion of products sold remain constant. So CVP also has a static model, which is short term. So static analysis may not be really suitable for long-term planning. CVP also ignores time value of money. It does not consider timing of cash inflows and cash outflows. Okay, so that is about CVP. Let's look at investment appraisal under capital budgeting. What are the main advantages and disadvantages of the payback period? Why is a net present value approach considered to be the most appropriate tool for investment appraisal? So, what is payback period? This is an appraisal method that we use to calculate how long it will take us to recover our initial money. It is simple to understand and calculate and useful for assessing liquidity. It's shorter period, the more viable. However, it ignores all cash flows after the period when the money is recovered. So ignoring those other parts will make it not very reliable and ignores time value of money. It doesn't measure profitability. Its only concern is the speed of capital recovery. NPV, on the other hand, is considered to be superior because it considers time value of money and recognizes every quarter today is worth more than a quarter tomorrow. So it takes account of all the cash flows over the project's life and provides a direct measure of how wealth project will add to the company. A positive NPV means we are directly increasing the shareholders' wealth. So it is consistent with the objective of maximizing the value of a firm. So this is on the theoretical part. Mostly it will hover around those ones. So we go through now the calculation of CVP. So CVP simply tells you the point at which our costs are equal to the revenue. So 2018 exam, we have the budgeted sales as 48,000 oranges. The selling price is given by 3 kwacha. The variable cost is given by 1.5 kwacha, and the fixed costs are given by 30,000. So calculate the break even, the margin of safety, calculate the number of units to be sold to have a target of 60,000. So let's get to business. Okay. How do we calculate each of those ones? So firstly, in the previous class, I think I labored hard to explain principles like the contribution, how to calculate the contribution, how to calculate the margin of safety. So maybe before I go there, any questions on CVB?
None.
Okay, so I don't know the mixture of people that I have, whether I have beginners or we can go into calculation. Do I need to explain a bit?
Please,
Okay.
please explain.
But one worrisome thing I'm really concerned about is whether you are watching my videos or not, because the reason why I'm sending the videos is to reduce on the back and forth in because all this, the exact question was done in my video the other day, and I've been sending the videos. Just that I'm trying to control some of these videos because some of you are sharing videos to, I'm seeing the usage of my videos a little bit high. So I'm going to limit based on your email. So I don't allow my video to be shared without authority. So after I'm done with that,
Maybe,
yeah.
maybe Mr. Collins, the videos also, I don't know how you share them.
Um, um, they're only exclusively to you paid up. So they're open so that you can watch them at any time. So if you are going to be a good Samaritan to give free riders, I think it will not augur well because we are allowing people not paying for the service to enjoy the service. Anyway,
So you have you link it to our email addresses. You have our email addresses.
well, I'll
Yes,
find a way of
the
encrypting them, but
videos.
again, um, I just admonish you not to share my materials. Okay, they're exclusively yours. All right. The only things I can allow you to share are links when I want people to just see what you're learning, not the videos. Okay, so let's quickly go to what is involved in CVP. Okay, so it is important to understand the background before we do the calculation. So the whole idea here, firstly, there are elements that we must know. There's what is called the contribution per unit. The contribution per unit. So let me go through the brief notes so that as we do the calculation, you are able to relate with me. So under CVP, you always have to understand how to calculate what is called the contribution per unit. So contribution per unit is simply the amount that each unit sold will contribute to covering a fixed cost. Okay, then to the profits. So contribution is simply given by the selling price minus a variable cost. So if your contribution is zero, it means the firm can never cover its fixed costs. If your contribution is less than zero, it means each unit you sell will increase your losses. And if your contribution is greater than zero, it means you are covering a certain portion of the amount that you hold in your fixed assets. All right, so this is what we call the contribution margin ratio. It is very useful for value calculation. So contribution margin ratio is simply the contribution itself divided by the selling price. Or since contribution is simply selling price minus variable cost. So it is simply the selling price minus variable cost divided by the selling price. So this contribution margin ratio is used to convert the break-even sales value easily. So it shows what proportion of your sales are available to cover your fixed costs or your profit. So we'll need to learn how to calculate the contribution margin ratio. It's simply the contribution divided by the selling price. Another important component is the BEP. It comes in two ways: the break even in terms of units and the break even in terms of what?
Value.
Okay. So break even is given by the formula fixed assets divided by contribution. And we know contribution is what? Selling price minus variable cost. So simply fixed assets minus divided by selling price minus variable cost. So this is how we calculate the break even in units. We also have the break even in value, where we simply multiply this answer we got here, the break even in units times the selling price. Okay, break even in units times the selling price. So sometimes they'll ask you just to calculate it in algebraic form. You make one subject of formula. So it's a point at which profit is equal to zero. Okay. So we also have what we call the margin of safety. Margin of safety. So a margin of safety is given by the margin of safety in units and margin of safety percentage. So it is equal to the budgeted or the actual sales in units minus the break-even units. A percentage is simply the margin of safety in units divided by the the budgeted sales. The budget sales we know are the actual sales times 100. So if you have a high margin of safety percentage, it means you have a lower risk of loss from a drop in sales. So you need to always check whether they want it in units or whether they want it in percentage. So there's a margin of units, margin of safety in units, and margin of safety in percentage. Okay, these are the key things that you need to know. Then we also have the sales needed for a targeted profit. The sales needed for a targeted profit, and also you need to understand how to calculate the impact that a price change will have, that we call sensitivity. So if you have a certain target profit, so to find the number of units required, you simply calculate that the units should be equal to fixed cost plus the targeted profit divided by the contribution. The contribution is simply uh, selling price minus what? Variable cost. Then the value required, simply these units you calculated, multiply times the selling price. Okay? Or you bring down this formula itself. Fixed cost plus targeted profit divided by um, uh, contribution over or times the selling price. So quick reasoning here, you simply want to have a targeted profit so that you understand how many sales you must have to make a certain target profit. Okay, then the last part simply is algebraic. When you're dealing with sensitivity, you just need to compute your new selling price if there's a change by a certain percentage, but the same procedures will follow. So now we want to go to our exam question of 2018. Okay, so 2018 paper, what paper was this? 2021. Okay, so the pamphlet that I've done, I've just summarized. I didn't write the question in full. I'll beam it, but let's try this together. Okay, so we're given following question. The data given number one, we have the actual sales, which are 48,000. The selling price per unit is 3 kwacha. The variable cost per unit is 1.5 kwacha, and the fixed cost. Let's find all those elements to start with. How do we find the contribution?
Selling price minus variable cost.
Okay. So it's selling price minus what? Variable cost. Okay. Do we all agree that is how we calculate the contribution? Selling price minus variable cost. Are we together? I'm just trying to ensure that we are all on the same page. So contribution is what? Selling price minus variable cost. Are we together with that? And what is our selling price?
3 kwacha.
3 kwacha. And what is our variable cost?
1 kwacha 15 ngwe.
1 kwacha 15 ngwe. So what becomes our contribution?
1 kwacha 15.
1.5.
Okay, so contribution is 1.5. Okay, then what is the contribution margin ratio? So I want to break this down for you so that we cover everything, even what has not been asked, so that whatever question, all those things must be identified. So contribution is simply the difference between our selling price minus the variable cost. So this is, everyone has understood that. And the contribution margin ratio is the same contribution you divided by the what? The selling price, this one here. So 1 kwacha 50 divided by the 3 kwacha. So the answer we get is what? The
0.5.
0.5.
0.
Are we together?
Yes.
Yes.
Okay. So anyone behind before I proceed?
No.
So I also need you to understand what the implication is. The contribution of 1 kwacha 15 weight simply means that Each orange sold will contribute 1 kwacha 15 ngwe to covering our fixed costs, okay, or generating a profit. Then here, a contribution of 50% percentage means that for every 1 kwacha of sales revenue, 0.5 kwacha goes towards fixing the costs or the profit. Then let's go to the third one. What is our break-even point? Who remembers break-even point? Break-even point we said is what? EP's
Fixed costs
First cost
divided by
by
contribution.
over the contribution, correct. Fixed cost over the contribution. What is our fixed cost?
30,000.
Given as 30,000, correct. And what was our contribution?
It was 1 kwacha 15 ngwe.
1 kwacha 15, we're correct. So when we divide, we get 20,000 units. What do these 20,000 units mean? Means that the business should sell 20,000 oranges to cover all the fixed costs, okay? So any sales beyond this point will generate a profit. Any sales below that cost are in a loss, all right? Are we together?
Yeah.
Okay, we're together. Then we go to the margin of safety. We had talked about the margin of safety. Do you remember? Okay. Who remembers the formula for the margin of safety? We had two. Margin of safety in value and
We
margin
had,
of safety in
we
units.
had one in units and in percentage.
Yes, in percentage, correct. So the formula, do you remember the formula for margin of safety? So margin of safety, it seems to be the difference between what? The budgeted sales minus the break-even units. Okay? The budgeted sales were the actual sales that were given here. So if we go to our question, our budgeted sales were 48,000. All right? Budget sales were 48,000. And the actual units we calculated as the 20,000 were just from calculating. So the margin of safety is simply the budget sales minus the break-even unit. So 48,000 minus 20,000, we get 28,000. So what does this 28,000 mean? 28,000 means what? The margin of safety shows how far the sales can drop before the business will incur a loss. They will at 28,000 units. Okay. Then we also have what we call the margin of safety value. The answer we got, we just multiply by the selling price. So 28,000 times the selling price of 3/4, we get 84,000. All right. What does 84,000 mean? 84,000, what do they indicate? Okay, then there's also the calculation of the margin of safety percentage, simply the margin of safety in units over the budgeted sales. So the 28,000, okay, in units over the budgeted what? Sales of what? 48,000. So here we get 58.33. 58.33, it means that at 28,000 units, that's a buffer. It is significant. So the firm could lose over half of its planned sales, the 58.3, before hitting the break even. So it indicates that there's low risk under this current picture. All right. So what other thing did we learn how to calculate? We learned how to calculate the what? The targeted sales. So here we are targeting sales of 60,000. So to find the units required to get that 60,000 is fixed cost plus targeted profit over the contribution. So our fixed cost was 30,000, our target profit now is 60,000 divided by the contribution. We're getting what? 60,000 units. So the 60,000 units, what does it entail? The 60,000 units, what does it tell you? So it means that to earn a profit of 60,000, the firm must sell 60,000 oranges, okay? Which is 12,000 more than that of the budgeted. Our budgeted was what? 48,000, but we need to sell 60,000. So the implication is that if the market cannot support us by buying this 60,000, achieving this profit is impossible. So with that being said, I'll need you to comfortably answer all these questions here up to C. So I've answered the question indirectly, but I now need you to answer up to C. So that's where we've gone. So we'll pause. We'll end here for now. We'll continue first thing in the morning tomorrow. So that will be your homework. You capture it.